Hi, my name is Mike Resnick, and I'm an associate in the tax department at Sutherland. I'm joined today by a partner in the tax department, Ellen McElroy. And in this discussion today, we'd like to speak with you about changes in methods of accounting.
That's right, Mike. Invariably, when a company is thinking about a method of accounting, it's because they're interested in changing their method of accounting. Companies frequently change their method of accounting when they want to either accelerate deductions or defer income recognition. Importantly, accounting method changes can also be considered when a taxpayer wants to prevent the service from taking unfavorable action. Let's turn and talk a little bit more about changes in methods of accounting.
Sure, Ellen. And before we dive into exactly what a change in method of accounting is, it's important to note that under the Internal Revenue Code Section 446E, taxpayers must obtain IRS consent in order to make a change in a method of accounting. So whenever a taxpayer is considering making a change, they must also consider that the IRS will be consenting and recognizing that change.
That's right. And even though the government has never specifically defined what is a method of accounting, in their regulations under 446, they have defined what is a change in method of accounting. And that definition is pretty broad. It can be a change in an overall plan of accounting, and those are generally thought of as cash accrual and hybrid methods. Or it can be a change in the treatment of a material item. A material item is generally thought of as something like depreciation or inventory or capitalization. The regulations further define a material item as an item involving the proper time for inclusion of an item of expense or taking an item into account for income.
When looking at methods of accounting and changes in methods of accounting, there are several different types. First and foremost, we have statutory changes in methods of accounting.
Well, the statutory changes are the ones that are easiest to find because it's when a method of accounting is specifically referenced in a statute. For example, 448 has a reference for a 381, 460. The government has also provided us with extensive guidance involving procedural rules for changing a method of accounting. Those procedures control when a change is made on an involuntary basis, which is not really very much fun. That's when the service comes in and imposes an accounting method change. But there's also procedural guidance regarding voluntary changes, and those changes are initiated by a taxpayer. They can be automatic, for which the service has given their previous consent, or they can be non-automatic. And the non-automatic changes are referred to as advance consent because you have to secure the service's advance consent before you can make the change. Let's look in detail about those voluntary changes.
Sounds like a great idea, Ellen. When making an automatic method change, taxpayers receive the benefit of not having to pay any user fees, whereas with a non-automatic method change, user fees are accompanied. Additionally, automatic method changes are due with the filing of a tax return, whereas non-automatic method changes have until the end of the taxable year on the last day to make a change in method of accounting. Naturally, since automatic method changes are due with the return, they must be filed with the return. Non-automatic method changes must be filed with the IRS National Office. And an important note is non-automatic method changes are often greeted with additional subsequent information requests from the IRS. Naturally, automatic method changes don't have those additional requests, being an advanced automatic method change. Thank you so much for joining us today in our discussion of changes in methods of accounting. For any questions or concerns, please feel free to contact either of us. And for more bottom line videos, please access Sutherland.com.